Hi, and welcome to our talk on the Minnesota pass-through entity tax and why it matters to you. Glad to have you listening here. It is what the Minnesota pass-through entity tax, it's a new tax that is out there, and it's actually, rather than a new tax, it was a new opportunity. So we want to talk about what is it, how does it work, who qualifies, who should make the election, and cash flow issues. But like most taxes, you have to remember they're ever evolving. Like one of the common statements that is that a tax is permanent until it is changed. We've been going through a period of ever increasing change. So this information is as of November 1st, 2021. It might be changing, but it's a good place to start for where things are today. And who knows, this might actually remain constant for a while. Only time will tell. So what is the Minnesota pass-through entity tax, or PTE? This is Minnesota's answer to the SALT limitations on individual income tax returns. Our small business owners are finding out that the taxes that are imposed on their business income are often not deductible. C corporations can deduct all their state income taxes. So think of this as a way to help level the playing field between a large corporation like Target, that's a C corporation that can deduct all their taxes, and businesses like yours and mine that where the taxable income of the business are taxed on our personal returns, and we may be not able to deduct any of our state income taxes or a small portion on our personal tax returns. Before 2018, it wasn't as big of an issue because state income taxes were allowed to be able to be deducted on our personal tax returns without limitation. That is no longer the case. There's substantial restrictions on the amount of state taxes that can be deducted. So what we want to do is try and level the playing field. And there's a way here we can do that with the pass-through entity tax. So this is, it took a while to get this to evolve over a period of time. And the big change happened November 9th. So when the IRS issued a notice that said that there can be SALT workarounds, the states were trying to figure out, is there a way that we can allow our small business owners to be able to deduct their state and local taxes and yet not impact the state overall tax collections? So the IRS acknowledged that we know that states, you're looking for a way to do it. If you follow these pass-through entity taxes, we agree that this will be an allowed deduction on the business and will not be deemed a personal income tax deduction that's subject to limitations. With that understanding that there are ways to work through this pass-through entity tax, Minnesota has a new law that was signed on July 1st, 2021, that was authorizing the Minnesota pass-through entity tax for years beginning after 2020. So the Minnesota pass-through entity tax really began with a federal notice in November 9th, 2020. What happened here is the IRS acknowledged that we know that states, you're looking at a way to work around the tax limitations on business income. And if you follow a pass-through entity tax structure, we will respect that as a business deduction rather than an individual income tax on the business. So if you can follow a structure of a pass-through entity tax, we know what you're doing. We know you're trying to work around these limitations, but we will respect these type of choices. So with the understanding that the IRS was going to bless these type of agreements on July 1st, 2021, the governor signed a tax bill authorizing a Minnesota pass-through entity tax. It's for years beginning after 2020. So this is brand new for anybody. You didn't miss an opportunity in the past. Then in September, the Minnesota Department of Revenue issued some FAQs on really what does this new statute mean. And then we had draft forms and instructions to look at that were available in October. So now we have an idea of what Minnesota's system is going to be. So here's how it really works, is the entity, that is the business, pays a Minnesota tax on its Minnesota income at the highest individual income tax rate, which is currently 9.85%. This tax is deducted against the business income. It's treated as a business expense. The tax deducted will end up being added back to the Minnesota individual income tax return on the person's return. And then the individual will receive a refundable credit against their Minnesota individual income tax return. So what happens, the business pays a tax and then the individual gets a credit. So let's look mathematically what's really happening here. So under the current system before 2021, with no pass-through entity tax, if there was a business that made $100,000, that was a flow-through entity, what happens? The $100,000 passes through on a K1 to the individual income tax return where $100,000 is added in. Now, for most of the small businesses, remember there's that qualified business income deduction that for many businesses allows you to deduct 20% of your net income for federal purposes. So we back off $20,000. The net impact on adjusted gross income is $80,000. If I assume that you're in a 24% tax bracket, that means there's a federal tax of $19,200 on this $100,000 of income. Now, with the new election that's possible, we'd have the $100,000 of taxable income. Then there'd be the pass-through entity tax deduction of $9,850. That is 9.85% of the $100,000. That would get us to a revised taxable income of $90,150 after that, deducting those taxes that are paid. That will then impact my qualified business income deduction. It would be 20% of the revised amount. So it get me down to $18,030. The net impact on adjusted gross income then is $72,120. That's the amount I'm going to add to my taxable income. 24% rate gets me to $17,309, or almost a $1,900 difference. Now on Minnesota, why did Minnesota pass a statute that you got a change in income? Well, we're going to see that actually for Minnesota purposes, there's no change in the overall collections. So the K1 income currently is $100,000. That if we assume that they're at the highest tax bracket of 9.85%, that's a $9,850 individual income tax. Business paid nothing. The net individual income taxes is $9,850. If we look at how it would be handled under the new system, new election that you can make, there'd be $90,150 added in if there was a pass-through entity tax election made. Then on your Minnesota return, you're required to add back the pass-through entity taxes deducted. In this case, we're saying it's $9,850. Gets me back up to the same $100,000 of taxable income. We calculate a Minnesota tax of 9.85% on that. Gets me to $9,850. But then I also get a credit of $9,850, getting so that my net Minnesota individual income tax is 0. So let's put this all together. So on the federal level, we would have a federal tax on my individual return with respect to this business of $19,200. if I made the pass-through entity tax election, be $17,309, difference of $1,891. If you look at the individual without a pass-through entity tax, Minnesota collects $9,850, and that is collected from individual income taxes. If I have a pass-through entity tax, while the individual income tax is zero in this situation, Minnesota is collecting $9,850, but from the business rather than from the individual, getting Minnesota to the same overall collections, just collecting from a different person. And that's really what this system is moving the tax on the business to a deduction on the business. That's all it is. Now, if we look at the impact on this election on the higher income taxpayers, if you're in the current top tax bracket, that's 37%. What is the net impact on that rate of this deduction? How much of a percentage benefit are you getting by making the pass-through entity election? If your business qualifies for the qualified business income deduction, the net impact on your federal rate is in essence a deduction of 2.9%. Now, if you're in a business that does not qualify for the qualified business income deduction, then the net impact on your rate, if you're in the top rate, is a reduction in the effective rate by about 3.6%. By coincidence, this savings will approximately offset the additional net investment income tax that will likely apply to these taxpayers if the Build Back Better bill passes in its current form. We don't know what's going to happen with that bill. We don't even know if it's going to pass. But if it would, and you would be subject to the net investment income tax on your active trader business, this election made on your Minnesota return would have the impact of about offsetting that tax increase for you. Now, do we know this will be accepted by the IRS? Well, we believe that it will be, because remember that notice stated that they will allow this as a business deduction, but it said that they were going to issue a proposed regulation following the logic of Revenue Ruling 5825. That's right, the first two digits 58 mean it was a ruling issued in 1958. That revenue ruling allowed a deduction of local taxes paid by a partnership. It said that they would allow this tax as a deduction as a non-separately stated deduction. May seem like a nuance to you, it's a big deal. Non-separately stated means it's blended with all your other deductions, just like cost of goods sold and payroll. So since it's like everything else, it's not separately stated, that means it comes through as and reduces the income of the business. It does not come through as an itemized deduction. And it is stated in that notice that this will be the result, even though there's an offsetting credit, or if the income is excluded from the state income tax return. So in other words, they're saying, we know what you're going to do. We're okay with it. Now, it did say that they were going to issue a proposed regulation. That was almost a year ago, and it's still not out. We're expecting that, but they're telling us what they expect it to say when it does come out. So this is the logic we're following. So should I even bother doing this if there's a possibility that the state and local tax limitations might be changing the upcoming legislation? There's talk right now about increasing the amount of state taxes that can be deducted on your personal return. Well, one, the Build Back Better bill is not passed. We also don't know how it will be addressed. Congress is still debating it. So by using this other mechanism, we don't have to worry about what Congress would do. Secondly, even though Congress may allow all the state and local tax deductions, not everyone itemizes. So it'll help everybody, even if you don't itemize. And maybe you're taking a standard deduction currently, and allowing you to deduct all your state taxes might allow you to itemize. That gap between your deductions excluding this additional state and local tax and the standard deduction is lost tax deductions. There's no benefit for that amount. Remember, when you itemize, you only get a benefit for the deductions above the standard deduction, not all of them. And another one that's really important is there's no AMT adjustment for state taxes paid by the business. In other words, if you deduct your state and local taxes as an itemized deduction, there's an alternative minimum tax adjustment for the state and local taxes paid. The taxes paid by the business as a non-separately stated deduction run through just like payroll or cost of goods sold, and we do not have to add those back. So there's not a risk of your taxes being increased due to alternative minimum tax. Who qualifies to make the pass-through entity tax election? It's a Minnesota partnership, limited liability, or an S corporation that does not have a partnership, limited liability company, or corporation as a member. Now, disregarded entities are fine as long as the underlying entity is not a partnership or corporation. Then they can elect to pay the tax at the highest state tax rate, and the tax is imposed on qualifying entities of the entity. In other words, qualifying owners of the entity. Who are qualifying owners? Qualifying owners are individuals or estates that are partners, members, or shareholders of a qualifying entity. And they may be a resident or a non-resident. A trust that is a shareholder of a qualifying S corp is also a qualifying owner. This excludes trusts that are partners in partnerships. They don't qualify. Now, estates are fine in a partnership, but a trust is not eligible unless it is a disregarded entity. So let's talk about what these words really mean. So let's look at a couple structures. So if I look at the standard limited partnership structure where I have a 5% general partner, that might be another partnership, and the other 95% is owned by limited partners that are 10 individuals. Would that structure work for this tax? No, it doesn't, because I have one owner, a partnership, that owns part of the interest. One owner that is not an eligible owner eliminates anyone from benefiting. So that particular partnership doesn't work. Now let's look at the partnership that owns that 5% interest. It has to file its own partnership return. Is that entity eligible? Well, if I assume that I have that partnership is owned 50% by an individual and 50% by a revocable trust that's owned by an individual, that will still work, even though I have a trust in there, because a revocable trust is a disregarded entity. So we look through it. The owner of the disregarded entity is an individual. So in essence, I say I have two individuals, and that structure works. So just because an entity makes it so that someone else can't use the pass-through entity tax doesn't mean that that can't be done by the actual owner itself. What if I have a partnership with 10 equal partners, 9 are individuals, and 1 is a profit sharing plan? Will that work? No, it doesn't work, because a profit sharing plan is a trust, and trusts don't work. So no one gets the opportunity. What if I have a partnership with 10 equal partners, 9 are individuals, and 1 is an estate. That structure still works because an estate is not the same as a trust. Even though they file the same income tax form, they are different types of owners. So how do we make this election? We make this election by making sure we file a timely tax return. And the timely tax return does include extensions. And when we file that timely tax return of the entity, we have to make sure that members who own more than 50% of the interest in the entity agree that that's a good idea. That election is binding on all qualifying owners, not just those that elected. So this is where the majority controls the minority. And it's irrevocable for once that election is made for that year. So if you choose to follow this for a year, you can't go back and change your mind. So this is the form itself. Now it looks complex and complicated. The reason it's a little more complex is it has to deal with non-resident owners, and it has to deal with Minnesota modifications on federal income. Biggest of those tend to be depreciation adjustments. But what I want to show you on here is that on the second page, when you list out all the owners, notice that no one has to sign the form. I was concerned that we would have to have an election, an affirmative election by people showing that they agree that this was the right thing and filed with the return, but that's not the way it is. We're just going to file this form showing the tax calculation, showing the people impacted, and how the pass-through entity tax should be allocated among the members. So that's really it. It's about filing the form on a timely return. So there are still some open questions. How do you going to document that more than 50% of the ownership agrees with the choice? Now, for many of our clients, they have one owner. They only have one owner, or 1% owns more than half of the entity. When they approve the filing of the tax return, in essence, they're approving everything within the return. So we have that election documented by their approval of the tax return. But if we have more owners or more complex ownership, we might be asking you to affirmatively state in minutes or something that this is good. But it shouldn't be a onerous choice, but something to keep in mind. And what happens if you file a late return? We don't know if it'll be allowed on a late filed return. Right now it says it has to be timely. Maybe it might be one of the consequences of not filing a timely return is you don't get this choice. Time will tell. There's still some open issues. If you look at the notice as drafted, if you look at the statute as drafted, and go back to the original revenue ruling, they address some issues, but not everything. The revenue ruling from 58 addressed business income. Does it apply to investment income? Passive income? We just want to watch for how that might be addressed when the IRS gets around to issuing the proposed regulation. Now, the notice also said that accrual basis taxpayers and cash basis taxpayers only get a deduction for the taxes paid within the year. So there can be a difference between the amount of the credit that's passed through and the amount of the deduction that you are allowed. So to make it simple, if I have a accrual basis taxpayer, my same taxpayer that earned the $100,000, the amount of the credit is always based upon the calculation of the income. It is not based upon when the taxes are paid. So if my total income is $100,000, I will pass through a credit of $9,850. The deduction I'm allowed to offset, if I paid that $9,850 by December 31st, that means that I will get a deduction. I will reduce that federal taxable income in 2021. If, however, I pass that, pay the tax in 2022 for 2021, what'll happen is I'll still get the a credit will pass through in 2021. I just won't get a deduction, reduce my federal taxable income until 2022, even if I'm an accrual basis taxpayer. Now, the notice issued by the IRS makes it very clear that their notice only applies to partnerships and S corporations. Now, the Minnesota statute makes it appear that sole proprietors that are structured as limited liability companies legally could benefit. But based upon the IRS notice and actions taken by the Minnesota Department of Revenue, looks like sole proprietors structured as limited liability companies would not be able to benefit from the flow-through entity tax structure. Now, why would someone not make this election? So if I'm a non-resident, I might not get a state tax credit for the pass-through entity tax paid to Minnesota. Now, the Minnesota structure is attempting to address this by stating that the pass-through entity tax also qualifies as a composite tax return. In other words, that it qualifies to take care of the individual responsibility. This is where Minnesota is trying to give non-residents a benefit to states that say that you just don't show the income on your personal return. It's difficult to claim a credit for the other state, for the non-resident state, for the taxes paid. Maybe you're a non-resident with passive loss carryover to offset that entity's income. So overall, I don't have any tax anyhow. So you might not have a overall state liability, even a filing responsibility when the results are computed. Well, in this case, there is extra complexity. You'd rather not make the election because why pay in the tax? It means for you to get a refund of those taxes, because it's a refundable credit, you would have to file a Minnesota tax return. That is, you'd have additional. Now, why would a Minnesota resident not want to pay the pass-through entity tax? Really, it's just about cash flow issues. It's the best thing that I can come up with. Because what I really see are upsides. It is a refundable credit, so you'll always get a tax refund. If your tax is zero, you'll get a refund of everything paid. It'll also help with NOLs, meaning the use of old NOLs carrying forward, possibly an increase in NOL for if you had a tough business year, it might increase your NOLs to carry forward and offset other income. And you're saying, well, what if I had other business losses to offset all this business income? What's the benefit? Well, now you're going to use that credit to offset your wage and investment income taxes. So there is not a whole lot of downside for a Minnesota resident to make this other than the cash flow of paying the tax. So why do I keep talking about cash flow? It's because we have a 1 year big cash flow problem. Because if you look at what happened, individuals have to pay estimates in April, June, September, and then January. So by the time we had the statute didn't even exist for the first and second quarter estimates, so people would have paid those on their flow-through income as a person. We didn't have any information on how Minnesota was thinking of addressing this until September 14th. That's within 24 hours of the third quarter estimate due date. So pretty much everyone had paid third quarter estimates. So our individuals had already paid 3 estimates, or 75% of the taxes on their 2021 income from their flow-through entities. They've taken money out of the business and paid it over to Minnesota Revenue. Now, if you want to get a deduction in 2021 for this and to use advantage of the flow-through entity tax, the business has to pay tax on all the Minnesota income by December 31st. So that means there's distributions for 75% of the taxable tax for the year. And now you're going to have to pay out 100% of the tax to get that tax deduction. So that means the business is now made through either through tax distributions or payments to the Minnesota Revenue tax on 175% of this tax. Why would you bother paying 175% of the tax in 2021? One, you're going to get a federal tax deduction that would otherwise be lost to you. And you will get a refund of the excess tax paid after you file your tax return. And the current interest rate environments the interest rates are quite low right now. So the opportunity cost of paying this money out now and getting it back later is relatively low. So yes, there's a short-term problem. We understand that, but we believe that the benefit outweighs the cost. So keep in mind that your Minnesota return will have an exact amount of tax calculated on it based upon your income tax filing method in cash or accrual. That means you pay in an estimated amount of tax in December, or maybe you paid it in March. That's an estimate, and then you look at what the actual tax is. That either means the business will get a balance due or refund when the final calculation is made. That will create a timing difference for our accrual basis taxpayers between the tax paid and the tax credit. There can be some difference for our cash basis taxpayers also. Just keep in mind, tax paid does not equal credit. We've gone through a lot of stuff here. Appreciate your time and patience. Feel free to give myself or your JAK tax professional a call. I'd be glad to help you walk through any other things that you may have questions upon. Thank you for your time and attention.